So let me welcome on board R.S. Jalan, the MD at GHCL, on the show right now. Mr. Jalan, good to have you in the show. Given that you have a large 25% market share in the soda ash business, help us understand what's the demand environment currently like?
You see, overall, the demand has almost come to the pre-COVID level already, and we are seeing a very healthy demand going forward because all our consuming sector, be it a detergent or the glass, everywhere the demands are picking up. And our understanding about the overall demands will be on a positive note going forward. The second important point here, which is again very important for this industry, the supply chain cost of the material coming from overseas has gone up very significantly. Almost it has gone by 3 times. And because of that, overall, the cost for the imported material has also gone up. The third important point again for this industry at this point of a time is overall globally also the demand has significantly improved. In China, the demand is almost come more than the pre-COVID level, and the overall the export which they are doing has gone up to only one third. They were used to export approximately around 150,000 tons in a month. Last month they have done almost only 40,000 tons. So overall, I see a very good outlook overall in the demand of soda ash.
Sure. At what capacities are you currently running at, and are you back to pre-COVID levels?
Yeah, we are running almost around 95% plus.
All right. Okay. Hi, Mr. Jalan. This is Mubina as well. This is Mubina as well joining in. I wanted to ask you as well about the average realizations that you are seeing, like soda ash, etc. I understand that earlier this year, the realization, the pricing was a little lower. If you could talk to us about how that's shaping up, especially as demand as well as coming back. You mentioned that demand is almost back to pre-COVID. So if you could talk to us about that too.
Yeah, Ravina, good morning. You see, the overall in last 2 months, the soda ash prices had gone up almost around 17%. And our understanding, of course, there are some contracts which are slightly longer terms. If I take all those things, that in the fourth quarter of this year, this entire 17% price will come into the play of the on the revenue side. However, we also take a note of it that even the energy prices has gone up, so therefore the cost has also gone up. But of course, in the fourth quarter, you will find a margin expansion in this business.
All right. Let's talk about the textile business because I think that demerger being afoot is something that a lot of investors were watching out for. So tell us about the demand environment over there, a bit of the business over there. What kind of revenues are you seeing? And also, obviously, since it's textile, the export potential as well.
See, overall textile, as you know, that is moving in a positive territory because of the many initiatives which the government has taken or the global scenario which has changed. On one side, the government has expanded or extended the ROSTL benefit and given it clear for 3 years of clear visibility of that benefit will continue to the industry. So that's a one positive note. Second, overall, as you know, the China plus one strategy is also helping the domestic industry on the textiles front. The third, again, because of this changing cotton, the lot of retailer and a lot of countries they have banned the import made out of the changing cotton. So that also is helping. So overall, the scenario of and even I would say that FTA discussion which the government is having with the Europe, this is also going in a positive territory. So overall, I see a very positive outlook for the textile business for the India. And export definitely will, this will improve the export. Even the domestic demand also, we are seeing after the second wave, our understanding is that the demand for the textile for the domestic market will also significantly improve. However, one word of caution which is very important for this business is, even in this case also, the cotton prices has gone up very significantly. And that will have some impact on the margin pressure. So we visualize there's going to be a good positive growth on the revenue side. However, margin, definitely there will be some stress going forward.
Okay, interesting. When you say stress on margins, would you be able to quantify the same?
See, as you know, the textile business is a very volatile business. At this point of a time, I'll just give an example of one of the imported cotton, which is come from US. The price has almost gone up to around 80%. And we don't know how the scenario will be looking going forward. But yes, if I look at from the current context, the way we look at, there will be 3 to 4% drop in the margin you could visualize.
What your free cash flow generation is currently from the business, and which of your segments contributes maximum to the cash flows?
Uh, the maximum cash flow comes from the chemical business only, and as you rightly said, our almost the free cash flow or cash flow, I would say cash profit is almost around more than 500 crores, and out of that 70-80% comes from the chemical business alone.
Morning, Mr. Jalan. Nikunj Dalmia also joining in. Always good to connect with you. The soda ash industry in India is such that it gets a lot of advantage because globally it's difficult to import. Do you think this inherent advantage is here to stay?
Certainly, Nikunj, this advantage is going to be because, as you know, this is a bulk commodity where the supply chain cost is almost around 20% of the overall realization. And this 20% is a very significant amount. And in the current context, when a lot of supply chain consolidation has happened globally, this cost is going to go up. Keeping that into mind, and if I take the last 15 years of the data also, this clearly shows that this advantage to the any bulk commodity, cement or the soda ash, is going to continue. And today, one thing, Nikunj, also I want to address is globally also, you won't find any producing country has lot of import coming in unless there is a two scenario. One, there is a shortage of supply in that country, or there is a short-term dumping is being done by some of the country. Otherwise, normally in the long run, yes, this advantage will continue.
Is GHCL committed to just stay with soda ash and textile, or now you want to take a leap of faith in other businesses also? I mean, it's one of the oldest chemical companies. But if I frankly look at your expansion, you've not gone beyond soda ash. What stops you from going into the entire API business? What stops you from going into other, complex chemical businesses? Because you have understanding, you have an experience, but you've not innovated, some would say.
No, Nikunj, you are right. We have been very focused on our soda ash business, and we wanted to be a significant player first into the business where we are in at this point of the time. We are not trying to jump on anything which is jump on anything unless we are significant player on a particular business. And as you rightly said, we are already at this point of a time around 25% of the market share of the soda ash business. We are going to continue our journey on keeping our market share on the soda ash business. However, now the scenario has come in where we are definitely looking at some expansion in some of the chemical which are in a close reference to the chemical which we are producing. So yes, API and those kind of things is in our drawing board, and we are definitely looking at those possibilities.
In the long term, I'm not saying this quarter, I'm not even saying FY23. Does it make little sense for you to be in the textile business? The textile business is an old business. It was a business which was incubated when India was on a different kind of a, it was a different economy. Every large corporate house had a presence in sugar, cement or textile. So I'm not surprised that GHCL also had a presence in textile. But that business is no longer the higher margin business. So does it make sense to use your energy and resources to a business where we know there is volatility and the scope of return on equity and return on capital is limited?
So Nikunj, as you know that we are already in the process of demerging both the businesses, and there will be a separate company, separately listed and separately management, and separate, everything will be separate. And that business is going to be on its own path, and the chemical is going to be own path. So therefore, the two expertise required for the two businesses and two strategic advantages to the two different businesses in terms of global merger and acquisitions or the joint venture, both the businesses will have that opportunity. Having said that, see, I know that you're right that textile business is a low margin business. But you see, there are some basic advantages also of for India, especially for the textile business. You know that India is the largest producer of the cotton. We have a cost competitive advantage in terms of the labor cost and in terms of any other cost. So India has a huge advantage in the textile. I would not rule out that the textile is not a right business, but yes, separate management, separate focus, separate this thing is required.
So there are no plans to exit the textile business completely. I'm trying to perhaps get that answer out from you.
Like I said, we are already making two different companies, and at this point of time, we don't have any plan to exit completely from the textile business. We are going to run this business efficiently and make sure that this business also gives a return to our shareholders.
One hallmark of GHCL, I've tracked this company for years and years and years now, is that you have a strong dividend yield. It generates a lot of cash flow. After the demerger, what happens? I mean, for the soda business, will the dividend yield increase? What will you do with the cash flow generation which you will do?
See, Nikunj, look at this, like you rightly said, on the chemical business, you will find that there are two opportunities which are clearly in front of us. And what we have done over a period of time is try to balance between three things. One is the leveraging, second is the reward to the shareholders, and the third is the growth. So now this discipline of these three equation will continue. Like we have very clearly articulated our dividend policy, we have very clearly articulated our leveraging policy that we will not like to have more than 1:1 debt equity ratio. And the third, now we are on the path of growth. Like you know that we have already planned for a new soda ash greenfield project that will require cash. We are also looking at some expansion in the diversification of the portfolio, like you rightly said, some of the chemical. So therefore, we have a plan to make sure that all the three area we go in a optimum manner, and capital allocation must be done in a manner so that a highest return to our stakeholders could be given.